In early January 2026, silver doesn't feel like a commodity anymore. It feels like a live wire, quiet on the outside, violent in the current, because price is no longer the conclusion, it's the symptom. The strangest part is that none of this needed a big headline to begin, because the move has been building in plain sight for years, like a pressure gauge, climbing one notch at a time while everyone argues about the weather. And now the market is doing that rare thing it only does at the edge of a regime change. It is moving fast, but without sounding loud, as if the real shock is how normal it suddenly feels. Nothing here is accidental. I think $100 silver in the first quarter is not out of the question. The hard truth is that when a market starts printing $2, $3, $4 in either direction, like its routine, the price is no longer discovering value. Value is discovering the price. You can call it volatility if you want, but volatility is just the polite word we use when a crowd realizes they were all standing on the same trapdoor. Silver isn't acting like something that's being traded, it's acting like something that's being retrieved. There's a difference. Trading implies a choice. Retrieval implies urgency. When you hear stories of a dealer being completely out and then restocking only to watch it vanish again, you were not hearing an anecdote about a busy shop. You were rehearing a miniature model of how a system behaves when inventory becomes a rumor. Availability becomes conditional. Supply turns into a mood. The metal doesn't disappear from Earth, it disappears from the price you were mentally anchored to. That is the first anthropomorphic clue. Silver has started to behave like a creature that no longer wants to be domesticated. For years it sat in a channel, obedient, predictable, bored. Then it slipped the collar. And once that happens, you don't get to negotiate with the old personality of the market. One reason these moments confuse people is because they expect a single cause. A war, a crisis, a new law, a central bank announcement, something you can point at like a smoking gun. But silver rarely gives you that satisfaction. Silver tends to move like fog. It forms when conditions are right, and by the time you notice, you're already inside it. Even the obvious triggers don't behave the way people think. A futures exchange can tighten screws and loosen them. You can see talk of COMEX do a few margin nukes, and even the biggest one since the 80s, with a 30% rise for silver futures. And the average listener assumes that's the whole story. Margin goes up, price goes down, end of narrative. But margin is only a leash if the crowd is still willing to be led. When the psychology flips, margin hikes become a signal, not a deterrent. It tells the market the room is getting hot, which makes the people inside the room look for the exits faster. The restraint becomes the confirmation. The guardrail becomes the proof there's a cliff. That is reversal logic in its purest form. The system tries to look in control, and in doing so, it reveals it is reacting. Then there's the export narrative. You hear the phrase, China actually restricting silver exports. And the mind immediately jumps to apocalypse language, shortages, empty shelves, end times. But the more interesting layer isn't whether the metal exists, it's where the bottleneck lives. Because the modern silver story is less about ore and more about processing, less about what S underground and more about what can be turned into deliverable form, at scale, on time. When someone says they're going to control about 60 to 70% of the refined silver, wow, that's not a casual statistic. That's a map of leverage. It means a huge portion of the market is standing on a bridge owned by someone else. And bridges don't need to collapse to change behavior. They only need to look narrow. This is why you can have a world where there's no shortage, in the geological sense, yet the market behaves like scarcity is real. Because scarcity is not a fact, it's a function. It is what happens when the metal has to pass through choke points that can be tightened quietly. And quiet tightening is the signature of 2026. Look at how the shop-level anecdotes rhyme with macro reality. Silver can be present, yet not present at great prices. That line matters because it reveals the mechanism. The market isn't saying silver is gone. It's saying the old price was a subsidy. It's saying the old price was a misunderstanding that lasted too long. The same pattern shows up when you look at gold in the display case. There is zero gold in the showcase. Even while the price tag is enormous, and yet demand still clears it. That's a psychological tell. When people keep buying after sticker shock, they are no longer buying for upside. They're buying for relocation. They're moving wealth from one container to another because they distrust the room the wealth is sitting in. At that point, gold and silver stop being investments and start being exits. This is also why the gold to silver conversation becomes so emotionally loaded. People talk about ratios like it's a math puzzle, but in regime shifts, ratios behave like doors in a burning building. Everyone wants the same door at the same time, and the size of the doorway matters more than the elegance of your strategy. When the narrative turns into portability, older holders wanting to debulk, to trade bulk for density, the market stops being about return and starts being about convenience under stress. And convenience under stress is expensive. Now layer in the performance anchoring. If a crowd has the memory that we ended the year up 148% for silver, it changes the way every pullback is interpreted. Dips stop looking like danger and start looking like insultingly brief discounts. People begin to treat price weakness as a momentary glitch in a larger migration. That's how you get smart stackers, buying dips while others wait for a return to a world that no longer exists. This is where the psychological floor gets built. When someone casually says $70 silver is kind of crazy, and then treats over $70 right now as stability, treats it like a new floor, they were describing the normalization process. First, the market shocks you, then it dares you to get used to it, then it punishes you for thinking it will revert. That's how trends become eras. So when a dealer voice says silver could go all the way up to $150 an ounce, the number itself is less important than what the number represents. A market imagining that the ceiling is no longer a ceiling, only a temporary roof panel that can be lifted again. The point isn't that $150 is guaranteed. The point is that the market has stopped treating triple digits as fantasy. It has started treating them as sequencing. And sequencing is everything. Because what drives silver in this kind of environment is not one narrative. It is the collision of several narratives that Dunnet T normally align. Monetary anxiety, supply chain choke points, industrial demand that doesn't care about investor sentiment, investment flows that rotate not because they love metals, but because they distrust everything else. Even the crypto comparison, whether perfectly measured or not, functions as a social signal. When people believe the cool money underperformed while metals outperformed, the tribe starts to drift. Not all at once. Quietly, like birds changing direction mid-flight. And once the drift starts, the move feeds itself. Not because metals are suddenly trendy, but because they start to look like the anti-trend. Silver, in that sense, is the metal that benefits when the culture gets tired of believing in miracles. Now, here's the part most people miss. Silver's supply story is structurally awkward. You can't simply turn on silver production the way you turn on a faucet, because silver often arrives as a byproduct. It rides along with copper, with lead, with zinc, with gold. That means the silver market is a passenger in someone else's vehicle. If the primary metal slows, silver supply slows, even if silver demand explodes. So yes, higher prices can incentivize mining, but incentives do not create time, and time is the one resource the market never has when it needs it. That's why the deficit language matters. Even if the exact number of years is debated, the concept is simple. If consumption runs ahead of new supply for long enough, the market doesn't correct politely. It reprices. It reprices in bursts. It reprices with gaps. It reprices with the kind of daily moves that make people feel like the screen is lying. Silver becomes less like a commodity chart and more like a heartbeat monitor. And this is the core mechanism. The Sujan Gyalai Tam Lang is not a conspiracy and not a single event. It is the slow realization that the old silver price was the leftover artifact of an era when money felt stable, supply chains felt infinite, and industrial demand could be ignored. So as those assumptions die one by one, silver doesn't rally. It undergoes a structural re-rating that forces the world to pay, not for the metal alone, but for the timing, the refinement, the delivery, the trust, and the optionality that used to be free. Once you see it that way, the 2026 prediction stops being a number and starts being a diagnostic. Maybe a 30% rise would push us right over $100 an ounce. Not because the market is greedy, but because the market is adjusting to the possibility that the next leg is an English tea driven by excitement. It is driven by constraint. And constraint creates strange behavior. Constraint makes people sell when price spikes and buy when price dips. Constraint makes dealers restock and still look empty. Constraint makes the display case feel like a stage after the actors have left. Constraint makes a metal that sat quietly for years suddenly act like it has somewhere urgent to be. Silver is not promising you anything. It is simply refusing to go back to sleep. In late 1979 and early 1980, silver didn't climb like a normal market. It lunged, then staggered, then lunged again. And the whole episode ended up teaching a cold lesson. When a metal becomes a referendum on trust, price stops behaving like math and starts behaving like crowd control. The authorities tried to cool it with rule changes, higher margins, tighter conditions, tools that usually work when a trade is just a trade, but the very act of tightening became part of the story, like hearing a door lock and realizing someone expects a rush. And when the dust settled, what remained wasn't just a chart pattern, it was a blueprint for how a small market reacts when too much money tries to fit through too narrow a channel. Now look at early January 2026 and notice what's familiar, but also what's different. Silver is sitting around the $80 area while gold is hovering near the mid-4,000s. And the ratio between them has compressed into a range that forces a simple question. Are we watching a speculative sprint, or are we watching a repricing of the entire corridor that connects money industry and geopolitical leverage? In 1980, the story was dominated by a dramatic cornering narrative and a relatively smaller industrial footprint. In 2026, the metal has an industrial appetite attached to it that doesn't care about investor mood because it's wired into electrification, solar, electronics, and manufacturing systems that have no elegant substitute. The rhyme isn't the headline, it's the behavior. Once silver starts moving in large daily increments, $2, $3, $4 in either direction, when the market is telling you it has left the era of gentle discovery and entered the era of forced adjustment. And forced adjustment always arrives with quiet signals first. The first signal is the way normal theros has been redefined without anyone voting on it. A year ago, the idea of silver floating near $80 would have sounded like a late cycle fantasy, and now it's being treated like a reference point, not an end point. The second signal is the way physical inventory behaves at the street level. Not the dramatic claim that there is none, but the more revealing confession, we were completely out, followed by the even more important line, it just doesn't stay. That isn't a shortage story, it's a velocity story. And velocity is what markets look like when confidence changes sides. The third signal is how gold is acting like a parallel drain. When someone can say, there is zero gold in the showcase at these price levels and still describe steady demand, you're watching buyers treat metals not as bargains, but as lifeboats. People don't negotiate with lifeboats, they just get in. Put those together and the signal gets sharper. Silver isn't merely rising, it's becoming harder to hold down at the old price. Because the old price was built for a world that assumed frictionless trade and abundant refining capacity. This is where people get trapped by the wrong mental model, thinking supply is only about ore in the ground, when the modern bottleneck is increasingly about transformation, licensing, logistics, and the quiet power to slow flows without declaring a ban. Silver, in other words, is not just a metal, it's a route, and routes can be controlled without ever touching the destination. That leads directly into the global layer, because this is not a story that belongs to one country. China has moved toward tighter export licensing around certain strategic materials, and silver has been pulled closer to that gravity, less as an announcement, more as a posture. The posture that refined output and export permissions are policy tools, not just commercial paperwork. And when you hear a line like, they were going to control about 60 to 70% of the refined silver, even if the exact percentage shifts depending on how you measure it, the core implication stays the same, a meaningful share of the world. S-refined pipeline sits behind gates that can swing slower when it matters. India, meanwhile, remains heavily dependent on imports for silver, which means policy friction elsewhere doesn't take but corners to have to be catastrophic to become expensive. It only has to be inconvenient. And in the background, the broader commodity complex has been tightening in places where the market assumed endless slack. Copper and aluminum constraints, reshoring incentives, and strategic stockpiling logic that doesn't announce itself with sirens, only with procurement orders. This is why the global aspect matters. If the world is simultaneously electrifying, securitizing supply chains, and drifting toward export controls, then silver becomes a shared pressure point. Not because everyone is bullish, but because everyone is behaving as if optionality is scarce, and scarcity of optionality is what forces revaluation. Markets, of course, react before the public finishes the sentence. You can see it in the way price moves now, sharp gaps, fast recoveries, and the feeling that pullbacks don't relieve tension. They just change who's holding their breath. You can see it in the narrative split between paper and physical. Futures can be whipped by margin, by positioning, by leverage, but physical demand expresses itself like thirst, steady, unbothered by volatility, only annoyed by delays in premiums. You can see it in the way 2025 performance became an anchor. When a market has just printed a triple-digit percentage gain in a single year, it doesn't return to innocence. It returns to negotiation, and negotiation happens at higher levels because the crowd has mentally repriced what possible means. Even professional forecasts now talk openly about gold potentially pushing toward new highs later in 2026, and where gold goes, silver doesn't follow politely. It tends to overreact, then consolidate, then overreact again. This is the part where people ask, so what policy stops it? And that question reveals the trap, because the system has fewer clean options than it pretends. If central banks keep rates high, they risk breaking debt-heavy structures that are already leaning on refinancing cycles. If they cut too aggressively, they weaken currency confidence and invite real asset repricing. If governments try austerity, they collide with political reality. If they try growth by stimulus, they feed the very inflationary psychology that pushes people into hard assets. That's why metals thrive in these corridors. Not because the world is ending, but because the policy menu is crowded with choices that all taste like trade-offs. In that environment, the easiest solution is the one nobody has to vote for, the stealth adjustment, letting the unit of account do the absorbing while everyone argues about the symptoms. That is why silver feels like it's being pulled upward by something colder than hype. You can call it inflation hedging, You can call it industrial demand. You can call it geopolitics. You can call it speculative momentum. But the more accurate description is that the system is being cornered into a silent repricing, and silver is one of the few assets small enough to move fast and essential enough to matter. This is not the old game where a mine announcement settles the argument, because new mines take years, and much of silver is a byproduct anyway, meaning its supply can indeed respond cleanly to its own price. The market senses that lag like an animal senses weather, and it prices the lag, not the headline. So when someone says $100 silver in the first quarter is not out of the question, the real content is not the number. It's the admission that the market has accepted a new band of reality where triple digits are no longer a punchline. And when someone throws out $150 as a year-end possibility, the market doesn't need to believe it will happen. It only needs to believe it could happen, because could changes behavior. Could makes dips get bought. Could makes inventory vanish faster than restocks. Could makes the public arrive late, and late arrivals are what turn a trend into a stampede. The pattern is painfully simple once you stop looking for drama: a structurally tight metal plugged into industrial necessity, moving through policy-sensitive choke points, inside a macro regime where governments can't painlessly choose stability over liquidity. That mix doesn't guarantee a specific price, but it does explain why price targets that used to sound absurd now sound like scenarios. And in markets, scenarios are enough, because markets don't wait for certainty. They front-run the possibility that certainty will be expensive. What's happening isn't that silver suddenly became expensive. What's happening is that the world quietly changed the job description of silver, and the price is just the paperwork catching up. A year ago, most people still spoke about it like a trade, something you rotate into, rotate out of, and occasionally complain about. In early January 2026, it behaves more like a critical component with a temper, the kind of thing that doesn't ask permission before it reprices the room. And that single shift is why the big numbers done T sound as crazy as they used to. I think a $100 silver in the first quarter is not out of the question. Isn't it just a forecast? It's a confession that the market has stopped treating triple digits as science fiction. For this year, 2026, I'm thinking silver could go all the way up to $150 an ounce. That isn't a guarantee. It's the sound of a ceiling turning into a hallway. The mechanism is brutally simple once you stop staring at the chart and start watching the plumbing. Silver is a smaller market than most people intuit, but it sits inside very large systems that don't have the luxury of waiting. Electrification, solar buildouts, electronics, grid infrastructure, and now the quiet acceleration of AI hardware demand that eats connectors, solders, and high-performance components. Demand doesn't need to explode to create stress. It only needs to stay stubborn while supply stays slow. And supply, in silver, has a built-in delay, because much of it is produced as a byproduct of other metals. You can't just turn on silver output the way you turn on a faucet. It arrives when copper and lead zinc economics allow it, which means silver demand can strengthen while silver supply shrugs. Then you add the second layer, refining and export control. Ore in the ground is not the same thing as deliverable metal in the right form, at the right time, at the right border. China moving toward export licensing regimes around strategic materials doesn't take to have to create a theatrical shortage to change behavior. It only has to create a slower gate. Markets don't wait for a ban. They front-run friction. In that environment, price becomes a bidding war for certainty of delivery, see uncertainty of quality, certainty that a purchase actually becomes metal in hand. That's why you can have a world where silver is available, yet increasingly only at prices that feel like a penalty for arriving late. The metal hasn't vanished. The old price has. First-order impact shows up where the system is most sensitive: paper markets, spreads, and volatility. When silver trades with wide daily ranges, it stops being a polite asset and starts becoming a stress test for leverage. Futures exchanges react with tighter conditions, higher margins, sharper risk controls, tools designed to slow speculation. But in a regime shift, those tools can backfire psychologically because they read like warning signs posted by the venue itself. Volatility also changes the behavior of hedgers. Manufacturers hedge more aggressively, miners hedge more selectively, and everyone becomes allergic to being short optionality. The market begins to demand a premium not only for metal, but for time. Nearby supply starts to matter more than distant promises, and you can see it in how quickly dips get bought and how stubborn the market becomes around new floors. Meanwhile, physical tightness expresses itself in the most unglamorous way. Restocking becomes a treadmill. We were completely out is a retail line, but it maps onto a larger truth. Inventory is no longer resting. And it just doesn't stay is the real tell, because it describes velocity, not scarcity. Velocity is what you see when the public starts converting belief into action and action into withdrawal from the system. Second-order impact is quieter, but it's where the story becomes real. Higher silver prices don't just hit coin buyers, they ripple into the cost structure of manufacturing, especially for components that can't simply swap in cheaper materials without performance losses. Over time, industry responds with thrifting, using less silver per unit, substitution where possible, and redesigns that push the constraint elsewhere. But those are engineering timelines, not trader timelines. In the interim, higher input costs show up as margin compression, delayed projects, or small price increases spread across millions of products so no one notices the silver line item. The irony is that society can live with slightly more expensive gadgets and solar components, but markets don't price slightly. They price the risk that the constraint becomes chronic, and that chronic constraints eventually force policy to care. And once policy cares, uncertainty becomes a new commodity. So who wins and who loses if 2026 is the year silver fully accepts its new identity? Winners are not just stackers. Winners are the people and entities that already own reliable access. Primary producers with stable jurisdictions, refiners with capacity recyclers who can scale feedstock, and holders of physical metal who don't need to beg the market for delivery windows. Winners also include investors who understand the difference between price exposure and supply exposure, between owning a number on a screen and owning the thing the screen references. Losers are the late arriving public that treats silver like a lottery ticket, the overleveraged traders who mistake volatility for direction, and the industrial users who assumed global supply chains would remain frictionless forever. Losers are also anyone emotionally anchored to the old range, waiting for the market to apologize and go back to the way it was. Markets don't apologize. They just move on. If you map the cycle as it typically unfolds, without pretending this is a prophecy, it often comes in three phases. First is the accumulation and normalization phase, which is where early 2026 already feels like it belongs. A new price band forms, and the public slowly updates its intuition about what normal means. In this phase, the most important action isn't the highs. It's the refusal to break down when the crowd expects a reset. Second is the stress and headline phase, usually mid-cycle. Export licensing becomes a bigger conversation, inventory data becomes a fetish, and every geopolitical tremor gets translated into a metals quote. This is where spikes become more frequent, pullbacks become more violent, and narratives compete, some calling it a bubble, others calling it a floor being built in real time. Third is the restructuring phase. The market stops talking about price targets and starts talking about behavior changes, more recycling, more long-term offtake agreements, more industrial thrifting, more strategic stockpiling logic, and more political attention to critical minerals framing. The chart may still swing, but the underlying system has already adapted. And once adaptation begins, the old range becomes irrelevant, because the market is no longer pricing yesterday's world. From above, the pattern is almost clinical. A monetary environment that rewards hard assets, an industrial environment that consumes silver quietly but relentlessly, and a geopolitical environment that treats materials like leverage rather than merchandise. When those three align, silver stops acting like a passenger and starts acting like a steering wheel. That's why the $100 and $150 lines matter even if they never print exactly on schedule. They are not the destination. They are signposts that the market is no longer negotiating with the past. So the practical move isn't to worship a number, it's to watch the signals that precede the number: export policy friction, refining capacity strain, persistent deficits, and the speed at which physical metal gets absorbed on dips. If you want the earliest read on where this goes, follow the flow, not the noise. I'll keep tracking the signals that actually move the system, not the slogans that trend for a day and disappear.